A three-digit number invisibly dictates modern American life. This rigid mathematical algorithm determines your access to housing, transport, and long-term financial stability. A billionaire and a broke college student can have the exact same 850 credit score. That's because the formula ignores how much money you make. Tory Auto Loans takes a 660. A 620 gets a mortgage, but the lowest interest rates require a 740. Reaching 740 saves homeowners over $200 every month. This sample credit report from TransUnion shows the raw data feed that powers your score. It tracks every financial move you make, pulling specific data fields like your total balances and your history of on-time payments directly into the algorithm. Most people treat their credit score like a mystery. But once you look at the math, you see a predictable, mechanical system that you can learn to control. 90% of top lenders use the FICO scoring model. We can break down how FICO calculates your number using this 5-part pie chart. The largest slice is your payment history, making up 35% of your total score. The penalties here are severe. A single payment that is 30 days late can drop an exceptional 800 score by a full 100 points, and that negative mark stays on your record for 7 years. The second largest slice is credit utilization, making up 30% of the formula. Utilization is a ratio, your total debt divided by your total available credit limit. A common myth suggests that carrying a balance from month to month builds your credit. In reality, leaving debt on a card costs you interest charges and damages this 30% slice of your score. To get a good score, you want to keep that utilization ratio under 30%. To reach the exceptional tier, you need to keep your total balances below 10% of your available limit. These two components alone make up 65% of your financial reputation. Paying your bills on time and keeping your balances low represents the vast majority of the battle for good credit. The third component of the algorithm is the length of credit history, or your credit age, which accounts for 15% of the total. Closing your oldest credit cards can be risky. When you close an old account, you shrink your overall available credit limit and lower the average age of your accounts, which brings your score down. The final two pieces are credit mix and new credit, each worth 10%. Lenders prefer to see that you can handle both revolving credit, like credit cards, and installment loans, which are fixed-amount loans paid over a set schedule. This new credit category is also why people worry about checking their score. But pulling your own credit report is considered a soft inquiry, and it never hurts your number. When you apply for a mortgage or an auto loan, the algorithm has a built-in exception. It groups all lender inquiries made within a 14 to 45-day shopping window into a single minor hit on your report. Seeing this exact 100% breakdown takes the mystery out of the process. It transforms the credit score into a predictable system that can be optimized. Now that we understand the math, we can pivot to action. Credit is a tool that you can actively manage and use in your favor. You can bulletproof your 35% payment history slice by setting every credit card and loan bill to minimum autopay. This creates a fail-safe net that prevents those 7-year late penalties. To optimize utilization, ask for a credit limit increase. This lowers your debt ratio without spending cash. Or use the all zero but one method. Pay cards to zero except one. Leaving $10 shows active, low-risk use. To protect your credit age slice, take your oldest, no annual fee credit card and keep it open. Throw it in a drawer if you must, but never close the account. Managing these mathematical factors secures the best interest rates available. This builds the foundation for lower mortgage payments, faster debt payoff, and saving tens of thousands of dollars over your lifetime.